Hey, Don Mowry here with Thrive and Survive, the real estate show. I'm here today with Aaron Tennison with PRMG, and we want to welcome Aaron to the show. So, welcome,
Hey,
Aaron.
hey, how you doing, Don? Thank you
Great,
for inviting me.
always, always. And what we wanted to talk today is kind of about what's happening in real estate and in the mortgage markets, and to really like touch on the segments, what's happening with FHA, what's happening with VA, what's happening with jumbo loans. And so, I was reading an article today in CNBC, and I noticed that they said home sales were down nationwide in March at 21%. But yet, it goes on, there's still a demand for housing.
Oh, yeah.
In fact, I listed two properties, one in Rialto and one in Upland, and I sold them. I put them on the market on a Friday, and we were in escrow, by Tuesday. So there's still a demand out there. And why home prices are not home prices, but why home volume has slowed is because most people have taken their homes off the market. There's very few new listings, and also a lot of people that were listed delisted their properties, and therefore there's a lack of inventory. So Aaron, let me ask you, well, how are mortgage interest rates today for a conforming loan limit? And let me ask you, what is the conforming loan limit in San Bernardino and Riverside County?
Right now in San Bern, Riverside County, it's 510,400,
So
which
you can get a regular loan with for up to 510,450, you said?
510,400.
400. Oh, okay.
So
And
basically, if you're going to put down, let's just say 5%, that puts you just shy about a $538,000 home.
okay, so you can buy a $538,000 home with 10% down or 5%, you said?
5%.
With a little as 5% down. Awesome. And what are rates like on that particular product right now?
No rates. I mean, it all depends on obviously your credit scores, but they have a lot of factors that play into conventional interest rates. Loan to value, meaning how much you're putting down, what your loan versus your value, your credit score. But right now on with the higher end credit score, let's say 740 plus, you're in the mid threes,
Mid
and
threes, yeah.
mid to high threes on something like that, and then they progressively come down as that loan to value decreases.
Okay. And then, so yeah, I saw that the 30-year mortgage fixed mortgage rate fell to a new low, 3.43 last week, according to the Mortgage Bankers Association. One thing that we've seen, again, when you're looking at a home up to 500 and the mid 500,000 range, is that we've seen a big difference in the jumbo market with what's happening with COVID-19. So the homes that are 750,000 or $1 million plus, those are what's called a non-QM mortgage, correct? Can we explain
Well,
to
not
everyone, our watchers, what a non-QM mortgage is?
well. Actually, technically, non-QM is not your jumbo. It's your bank statement programs, your asset depletion, that kind of thing. And those about 30 days ago kind of up and disappeared. And the reason being they didn't have any kind of government backing, whereas Fannie, Freddie, they're owned by the government or ran by it. So they disappeared. I actually just got a text from one of my reps. They're slowly easing back into the game. But what you'll find in Riverside and San Bernardino County that we don't have versus, let's say, LA, Orange County, San Diego, is here we literally we have conforming, which is up to the 510, 400, and then we have jumbo. LA, Orange County, they have what they call high balance or non-conforming, which is still an Fannie Freddie loan up to, I think it's like 726,000. So they get the luxury of a slightly higher conventional rate, whereas here, unfortunately, in Riverside, San Bernardino, we instantly jump into the jumbo territory, which, as you know, anything north of Foothill is considered jumbo. And the banks have slowly creeped back into it. The non-banking institutions, again, I'm just now seeing them slowly getting back into the game. And the reason being is when all this came about, they had a ton of what they call margin calls. In other words, the lenders, they hedge. It's basically almost like gambling. they'll hedge a bet on these lower rates to make money down the road. Well, what happened is when all of this happened, the bonds skyrocketed. So did rates. That was partially due to just not having the manpower to handle. I think we literally got $1 trillion or just shy of $1 trillion worth of refinances in 3 weeks. That's half of what we closed in a record year last year nationwide for the whole year.
I saw a segment, a speaker saying that, the refinances were up like 300% from a year ago, but yet for refinance mortgage applications, but yet for purchase mortgage applications, for those who are buying a home, that they were down like 50%.
Mm-hmm.
So we're seeing a huge increase in demand for refinance because the rates are so low, and yet we're seeing the decrease because it's not that there's buyers who don't want to buy homes, that there's just a lack of inventory of properties on the market available. So tell me a little bit about, I know we're talked about, a lot of people are, with their jobs, some people they're not getting paid, they've been furloughed, and we're hearing different stories and scenarios. I've read a little bit of thing about Fannie Mae, about forbearance. So I'm hearing all these different things about forbearance, whether, hey, you got to pay it back in a lump sum, you can tack it on the back of the loan. And I just recently saw an article that some of the government entities are going to allow them to not have to pay that all in full. There's lots of confusion. So whoever's watching and talking to different, their clients or different people, they should really check with their bank before they decide to skip their mortgage payments and find out. Tell me a little bit about that.
Well, really, in fact, I just got done watching this morning. They had the chief financial analyst, I think, for for Lending Tree, I believe it was, on CBS, and going over the same thing. There's a lot of misconception that is all going to be due at the same time. In fact, I downloaded one of the actual scripts that Freddie Mac has put out to the servicers. So let's say, for instance, you call in, whoever, Penny Mac or Mr. Cooper or whatever is your servicer. They've got a script that they go down and ask you, hey, what are your hardships, et cetera, et cetera. And what they're typically doing, they can do anywhere from what they're saying 4, 6, up to 12 months worth of forbearance. They're starting more or less at the 4-month mark. And what they're doing is at that point, they'll basically look at your situation all over again. And if you can afford to pay it in one lump sum, cool. Which the odds are, if you needed the forbearance because you lost your job, you weren't saving that mortgage payment. So what they'll do is they can, break it up into installments over X period of time. Now, granted, this is Fannie Freddie. FHA is they have their own thing. And then and then from there, again, if they revisit you, if you're still in the same position in 4 months, maybe they extend it to 6. They extend it to 12, but it's not the way it was put out initially. It's not free money. You don't that payment doesn't go away. So what I've told people is, even if you are in forbearance, even if you can make a portion of that payment, do it, because that's just going to lessen the amount you owe at the end. But it's not this big giant balloon payment that it was, basically put out as in the beginning of all this. But
right. Yeah, it's quite confusing. And a lot of people think just because the fact that they have these programs, if they're still employed, they're still working, getting a check, it's really for those individuals who are not working, who've lost their job or have been furloughed. It's really meant for those individuals.
But unfortunately, we're finding, and trust me, I've honestly had my share of calls. Hey, should I do a forbearance? I'm like, why? You're employed, you can make the payment. So a lot of people are, take advantage of that, and it's more so because they don't know the repercussions, and some of those we don't even know what they are yet. Supposedly they're not going to report you to the credit bureaus, late, but what we don't know that, hey, down the road, let's say 12 months, you had a forbearance for 4 months. Is that lender going to consider that for mortgage late payments, and then now not do your refinance? Or if you're in forbearance, even if you're making your payments, lenders won't do your refi.
Right.
Who was telling me, I forget which bank it was, but literally, like when you log in online, instantly it pops up and says, "Do you want a forbearance?" And what was happening is, if you click that, you're in forbearance, even if you continue to make your payments. And then you turn around, hey, let's say 60 days later, rates are great. Hey, I want to refi, and then you're told no.
Right. Right.
Yeah.
So, yeah, I know we're seeing a lot of that. One of the questions I get asked a lot, I've seen, talking to a lot of potential buyers, and they're all saying, "Hey, we're waiting for the market to crash. Hey, we're waiting for prices to go down." And one of the things that I try to talk to people about is that, and I've been around doing real estate and appraisals for over 30 years. So I've been through the 90s market, I've been through the .com crash, I've been through the 07 crash. And one of the big differences I'm seeing this time around is that last time around when we went to 07, pretty much lending stopped. The lenders didn't know what to do. They weren't making loans, and there was no liquidity in the market. And so you can imagine if you had to go buy a car today, and you were going to go buy the average car, whatever is $50,000. You say, "Hey, everyone, we can't get an auto loan. All you can do is buy cash." There's not a lot of people that are going to be able to buy, are not going to go out and buy cars because they don't have cash. Same thing with real estate. Once you take out the financing, demand drops, because if you can't get a mortgage loan, then you can't buy a home unless you have the cash. And so that in 2007, that's exactly what happened. The lenders just stopped lending because they didn't know what to do. This time around, the lenders are out, the banks or the Federal Reserve, and the government's been out front, and they put trillions of dollars into the economy. That way, and they kept the conforming market, when I say conforming, the FHA Fannie Mae product, liquid, and that way people can still buy homes. And in fact, the National Association of Realtors is forecasting like a 1.7% increase in home values this year.
Well, I think it's been a 4.2% annual increase, I think I read this morning.
So they're still forecasting that we're going to be basically flat this year. Now, I can tell you from listing a lot of homes prior to COVID-19, we had what they used to call irrational exuberance. We were listing properties based upon the most recent sales, and we would list a home, and there was such a demand, and rates are so low that we were getting like 14 offers in 3 days, and people were bidding the property way up, and they were waiving their appraisal contingencies. Well, we're not getting that right now. What we're getting is people buying properties at market value. They're willing to pay. So what happened was prices were here, and then all of a sudden the demand was going up, and people are overbidding the property what the last comp sales were. But now we're not seeing that. We're just seeing them at market value, pretty much. And so we're not seeing. But the good news is that 2-3 months ago, you were competing against 14 buyers.
Oh yeah.
And they couldn't get in. Buyers are getting beat out all day long, right? So the good news is that if you're looking to buy a home right now, you're going to have less competition. Your offer is going to probably get accepted easier, and on top of it, you're going to get an awesome interest rate. Correct?
Oh yeah, and what we saw too is like you mentioned 07. I've been doing this same 28 years. So I've seen a few things. Lenders, unlike 07, 08, didn't stop lending. What they did, and the same thing, was a liquidity issue, mostly on the servicer's part. Partially the forbearance, partially just being stuck with loans that they paid. Let's say on average, servicers pay about 1% for a loan, and they collect about 30 basis points a year. So they're at about a 3-year break-even mark. So what was happening is loans were driving out because people were refinancing, nothing was coming in, so they were getting hurt that way. So then the Fed stepped in and decided, hey, let's buy all these mortgage bonds. So they bought billions of dollars in mortgage-backed securities. Well, they thought they were doing the right thing. Unfortunately, what that did is it just drove the bonds higher. So all those margin calls I mentioned earlier in our call, that spread just got bigger. So now all these lenders were having to pay even more money. So they've slowed down. I think I want to say they bought like 8.1 billion. But also, even this morning, I think last night, most of the lenders, and especially on your FHA stuff, which is known to be a 580 to 620 lower income, higher ratio kind of loans. Most of them across the board were going 660, 680, some 720 credit scores. wanting reserves. I mean, they basically turned it into a really clean conventional loan. Well, this morning we just came out, we're back down to 580. If you get like an automated underwriting approval.
When you say back down to 580, you're talking about a FICO score?
FICO score.
So you can get a loan with a FICO score 580, is that correct?
On FHA, as long as you get an automated approval through what they call DU or desktop underwriter, you can get it.
So you can buy a home with as little as 3.5% down using an FHA loan with a 580 FICO score.
Correct.
So a lot of people out there, who are renting and think they may not have the credit in order to qualify, might be missing out on an opportunity. And I can tell you that rents are going through the roof.
Oh, yeah.
The average rental right now in the Rancho Cucamonga area is probably about $2,500 a month.
At least.
And, every year, if you look on every year about, rents go up about every year about 3%. 2 to 3%, your landlord's going to raise. So in 10 years, if you're paying rent of $2,500 a month, that means your rent's going to go up in 10 years by $750 a month. Yet, if you buy a house on a 30-year fixed mortgage, right, your payment's going to stay the same. Your housing cost is going to stay the same. And on top of that, you get the mortgage interest reduction off your taxes. And so, when I look at individuals who are renting, if you can buy, maybe you think you can't, but it's worth at least reaching out to Aaron, just to, for a no commitment, no obligation conversation about, hey, is it possible? Can I buy a home?
Well, I can basically give you, again, no cost, doesn't cost you anything. It's a full blown report. It's called what do you call it? Either cost of waiting or buy versus rent. And just like you explained, it literally breaks down. Here's what you're renting, shows, the increases in rent. Here's what you're buying. And then it shows you what you're losing in, appreciation, equity gain, write-offs, all that. And so they can email me, call me, and I'd be more than happy to put that together for them.
Absolutely. Absolutely. Another thing too, is that if you're looking to refinance, now would probably be a great time. We don't know how long the government's going to continue to fund and pay down to keep mortgage rates low. And a lot of people don't understand that. What happens is, let me explain. When you get a loan and it meets this Fannie Mae or FHA standards, guidelines, that they package these loans up. The lender, like PRMG, will do, I don't know, let's say they're doing how much do you do, guys, do a month?
We closed $1 billion last month. First time ever.
$1 billion in loans. They package these up and they sell them off to the secondary market. And people buy these loans to get the interest and the income from these loans that they get. It's from income. And they auction these. And the government is using their own money. They're using their own money that we're printing to buy these mortgage-backed securities, correct?
Mm-hmm. Yeah, they're artificially keeping the rates low to spur the economy.
So if the government's buying basically their own paper, this government paper, GSEs, these government-sponsored entities, what they're really called, eventually they're not going to be buying these, and interest rates are going to go up.
Yep.
And so when they do, you're going to miss out on that opportunity to refinance your home. What other items, Aaron, would you like to share with us today about the mortgage market?
Some of the down payment assistance programs. There are quite a few out there. They, again, up and disappeared just because really what it came down to is these servicers, unlike 07, 08, didn't want to get caught with all these low FICO score, no skin in the game kind of loans that no one wanted to buy. So that's why you saw all these FICO requirements and everything skyrocket, because they knew they could sell this cookie cutter 740 credit score, 20% down kind of loan, where if you had your 600 credit score, high debt versus income ratio kind of FHA loan, no one wanted to buy it. They'd be stuck with it. So the DPA, or the down payment assistance programs, are starting to kind of sneak back into the picture again now. Once again, they don't go down to 580. Most of them are 640 to 660 plus, but there's help. They can help you with your down payment.
I see your assistant coming in back.
Here comes my assistant.
Homeschooling at its best, right? It's awesome. You got my daughter running across the back here, and your son and stuff like that.
Hey, it's what we do at home.
Well, awesome.
We were doing great homework right before this.
Awesome. Well, I wanted to thank you for spending some time with us today. If you have a mortgage related question, whether it's a purchase or a refinance, or you want to run by something by Aaron. Aaron's number's been going across the bottom. Aaron, what's the best number to get a hold of you at?
It's a 909-964-4516, and I'm right here in the Upland Rancho area. Have been for 20 years now.
Yeah, and if anyone out there is looking, has a real estate challenge, whether it's an appraisal question, whether it's a question about whether what your home value is worth, or how we can help you to buy a home. My office and staff, that we are available. We are still working. A lot of people say, hey, are you doing appraisals? And the answer is yes. Am I still going out to visit homes? The answer is yes. We are an essential service. We are also being able to do FHA drive-by appraisals, and so we're not having to go into people's homes if you have a high-risk situation. So again, it's worth picking up the phone, sending us an email, sending us a text to get your questions answered. That's what we're here for. So I want to thank you again, Aaron, for joining us today. If you have any questions, whether it's real estate, mortgage, appraisals, we're here to help you. And thank you for spending some time with us today.
Hey, thanks for the invite. Appreciate it.
All right.
Thanks.
Bye, guys.
Bye. No, you didn't.